The obvious advice that you'll always hear when war and conflict start is to invest in defense companies. I actually think this is pretty shit advice. Let's talk about why that is. If you're new here, my name is David and I'm looking to invest $100,000 of my own money into the public markets. I'm using this series as a way to show my strategy in public. I think this separates myself from most of financial social media because I want to show you exactly what I'm doing and how I'm employing my own capital, not just spewing hot air. Since I'm still evaluating investments, the money is sitting inside of a high yield savings account, earning 5% per year. Since I've started this fund back in August, I've already received over almost $1,200 in interest payments. This is great because if it wasn't in a high yield savings account, that 100K would have already lost value due to inflation. This would cause me to feel obligated to deploy the 100K quicker, and as we know, haste and emotion are the enemies of good investing. Now, the reason why I don't like investing in defense stocks is mainly for two reasons. The first, I love investing because I see it as a way to vote with your capital in order to play a small part in building a future that you want to see. And I don't want to see a future of war and strife. I'm looking for companies that will grow at 15 to 20% year over year for the foreseeable future. If our defense companies grow at this rate, we have bigger problems than a missed investing opportunity. I don't pass any judgment on those who don't share the same philosophy. It's known as impact investing. But the second and perhaps more important reason that I don't like defense companies is because most of the time, when I look at the defense companies, I don't like their economics. And this makes sense by the implicit nature of their business. Here's why. Defense companies fall under the industrial sector, and as you can see right here, under aerospace and defense. Their performance hasn't been that impressive over the past quarter, half of a year, and even 5-year view. And if we pick apart the actual companies that compose it, you can see that there are some winners, but over the course of the 5-year period, there's been no incredible performance. This gets even worse if you look at a shorter term view. And why is this? We're on the constant lookout for companies with a durable competitive advantage. A durable competitive advantage allows companies to do something very unique. The market gives them the freedom to price the products and services that it sells well in excess of the cost that it takes to manufacture those goods. This manifests itself as a high gross profit margin, a term I'm sure you've heard of before. Just to revisit, to calculate gross profit margin, you take revenue minus the cost of goods sold divided by that same revenue. A common trait of companies that have excellent long-term economics is that they consistently have higher gross profit margins than those that don't. Let's look at defense companies' gross profit margins to see why I don't like them. Here we have Northrop Grumman. You can go to their income statement and go to gross profit margin. And you can see it's around 21% and kind of floats between 18 and 24%. General Dynamics is similar, a little bit less, hovering between 15 and 18%. Boeing's is actually the worst of all, floating between 9 and actually having negative gross profit margin. Let's compare this against a company that does have high gross profit margin. If we go to Visa, we can see that they have a gross profit margin around 80%. It's because they're not manufacturing anything, they're facilitating payments. But still, in general, and there are exceptions, companies with greater than 40% gross profit margins may have some sort of durable competitive advantage. Whereas companies with gross profit margins below 40% tend to be companies in highly competitive industries. Any gross profit margin less than 20%, and again, there are exceptions, but this is a quick way for me to rule out a company as an investment. If their gross profit margin is less than 20%, they are in a fiercely competitive industry and may not have any differentiators that make the company stand out over competition. Investing in a fiercely competitive industry is not a great way to find a company that will beat the market. So if we're not investing in defense companies, what are we going to do in times of conflict? Luckily, we have a moment in time that is pretty close to today, and that is to look back into the 1970s, where there was a war in the Middle East amongst a period of high inflation. I actually think that times were a little bit scarier back then. You had the Iranian Revolution, you had the Yom Kippur War, you had a myriad of other things. And if we look back to Berkshire Hathaway's letter to shareholders, we can get some really keen insights. Here's what Buffett had to say back then. He wrote in his 1981 letter to shareholders, "We want businesses that are particularly well adapted to inflationary environments. Such favored businesses must have two characteristics. One, an ability to increase prices rather easily, even when the product demand is flat and capacity is not fully utilized, without fear of significant loss of either market share or unit volume. And 2, an ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with only minor additional investment of capital. This is simply not possible for defense companies. If you think about the company that produces our Ford-class aircraft carriers, Huntington Ingalls, the government can't just call them up and ask for an additional aircraft carrier. It's going to require a lot of capital. They have to build a new dock. They have to source all of the material required. They have to hire all the engineers. This is an extreme example, but just with most industrial companies, you need to be able to anticipate these rises pretty early on in order to match demand. These government contracts are closed years before and they're on a cost plus basis. It's hard to find a defense company that's capable of delivering the returns that we are looking for. So what do we do instead? I actually lied a little bit earlier before. If I were asked point blank if I like defense companies, I would actually have to respond with, it depends. This is because there are certain types of defense companies that I actually do like. It is ones that are not primarily defense companies, but have a defense contracting arm. This is most companies that you could think of. The government uses Oracle for some databases. They use AWS for cloud computing. Heck, even those aircraft carriers I mentioned early on have Starbucks aboard them. And I like this model. I like having a private arm and a public arm. Okay. And I really don't think there's any company that does that better than Microsoft. I really like what Microsoft's been doing lately in terms of their investments in AI, their acquisition of Activision Blizzard, and everything else that Satya Nadella has been doing. They really are going all in on AI. They just announced that their entire Office suite and Windows 11 is coming native with Copilot. I was flipping through their 2022 annual report last night, and I did find some things that piqued my interest, but that also made my corporate yoga babble bullshit detector go off. But overall, there are a lot of things I like about what Microsoft is doing. The more I thought about it, I wish I would have done full due diligence when they announced their partnership with OpenAI at the beginning of the year, when the stock was trading at a pretty low valuation, and I may have missed the train. But I'm not sure. I normally don't like investing in companies that are at their 52-week high, or worse yet, their all-time high. But this is a unique time for Satya. So in the next video, we're gonna deep dive Microsoft and see if it is in buy territory, despite having a $2.5 trillion valuation and trading near the all-time high. So if that's a video that you would like to see, please like, follow, and subscribe to make sure you don't miss it. Thanks for watching. We'll see you next time.